The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning and a very warm welcome to Squawk Box Europe. I'm Juliana Tatelbaum with Steve Sedgwick and Karen Cho. These are your headlines. UK inflation data just now hitting the wires. We'll get you the numbers and talk through what it means for the Bank of England's path forward.
Elsewhere, President Trump urging Republican holdouts to drop their objections to his budget plan in a private meeting, telling reporters he's confident the bill will become law.
It's not a question of holdouts. We have a tremendously unified party. I don't think we've ever had a party like this. There are some people that want a couple of things that maybe I don't like or that they're not going to get.
Tesla CEO Elon Musk commits to leading the automaker for the next 5 years, while also telling CNBC he plans to scale up the number of self-driving cars on the road by next year.
My prediction is that probably by the end of next year, we'll have probably hundreds of thousands, if not
hundreds of thousands,
if not over 1 million Teslas doing self-driving in the U.S.
Very good morning, Karen. Good morning, Juliana. We've got some great data hitting the wires. And ordinarily, one might be slightly worried about the hawkish nature of the CPI, which has just hit the wires. And we've got a great guest from Goldman's who's going to tell us more about it in a few moments' time. But the reason why I'm particularly nonplussed about this at the moment is we've just had our rate cut. We know we're not necessarily going to get sequential rate cuts in the United Kingdom. We also know, because at least one of us around the desk had the pleasure of reading 96 pages of the NPR, that the government and the Bank of England expects inflation to pick up mostly because of regulated price rises, because of what happened with our water bills, because of NIC changes, national insurance contributions. So we kind of knew it was going to be high-ish. It's slightly higher than people wanted to see, 3.5% year on year versus Reuters poll of 3.3%. The core figure coming in at 3.8%, excluding all those interesting things that you lot indulge in, such as energy, food and alcohol, tobacco. 3.8 rather than 3.6. So the UK CPI on month 1.2% as opposed to 1% in the poll. It is hottish, but I don't think it's anything particularly to worry about. And that is why, actually, very interesting. I mean, sterling's going up a little bit, but it's only following the trend we've seen over the last few days as well, where it's been firming up again as the dollar just eases off a little bit.
Bills. It wasn't much fun if you look at that CPI report. And of course, from water to energy prices to council tax, that was where I think a lot of consumers were throwing the extra pounds away. But there was a little element here, and the ONS was pointing to it this morning, around recreation and culture. So I think still these big music events that have been coming to London are really still moving the needle on the inflation numbers. It's not Beyonce this time. It was maybe Sabrina Carpenter for us and some of the other big acts for someone else. But
it's true. Some of these American chanteurs are, you've got Rodrigo, you've got Carpenter,
exactly.
You've got Billie Eilish, you've got Grace April. Where do they all come from? They're all amazing songstresses and great songwriters. I have listened to all of them. I've got 2 teenage daughters.
Well, it's just incredible how much they do extract from all of us. I think every one of us here has contributed to the inflation from the concert prices.
And even mentioning those thuggish brothers from Manchester who I'm desperate to go and see. Shall we move on? Because we've got a great guest.
We certainly do. Yuri Sten joins us. He is with us from Goldman Sachs, chief European economist there. Yuri, so we, as Steve said, we were expecting this number to be inflated for a number of reasons, but it has come in hotter than the market had been expecting, 3.5% versus 3.3% expected. What's your take on the headline?
Yeah, it's a very firm print, as you say. I would probably emphasize the services number in particular, 5.4%. That's quite a bit higher than expected, and also what the Bank of England had expected for this print. So I think this is going to reinforce some of the caution that we've heard in recent comments from the Bank of England. But then again, as you just said, it's a very noisy print. We had a number of price resets in here, from vehicle duties to water prices and so on. We also probably had an Easter distortion. Easter was late, that we think affected travel prices. And then also the national insurance contribution increase kicked in April, and that might have also affected the numbers here. So, we need to dig into the details component by component, but that would be my take. Likely a noisy number, but of course this is going to reinforce, at least in the near term, some of the caution. However, when we look further ahead, we still think we're going to see cooling on the wage side. We still think there's going to be somewhat slower growth than the bank is now projecting. So ultimately, we do think there will be more rate cuts. But I think near term, this is going to reinforce some of the caution that we've heard from them recently.
It's interesting you say you expect a cooling on the wage side over the medium to long term, because there is an alternative view out there that because inflation has been running pretty hot for the last 4 years, that the British public is therefore quite sensitive to any increase in prices from here, and that could translate even more quickly than historically in terms of wage demands. What's the counter there? Why don't you think that we're going to see more upward pressure in wages?
Yeah, I think the counter is that we've already seen a lot of the past inflation increases feed through into wages. So if you kind of look at where the level of real wages is, I don't think there's as much catch up to do anymore. We are also seeing some softening in the labor market when you look at, for example, vacancies that have come down. So in the past, I think it was much easier for workers to push for that compensation because the labor market was tight. It's now easing. And then also, I would say now some of the surveys about wage setting, wage intentions, they're still high, but they're beginning to come down. So when you look at, for example, the data on pay settlements that we have so far, they suggest that there's going to be cooling in the pay data. And I think the April, and so just to finish, I think the April data, which we will get in the middle of June for the pay settlements, I think that's going to be quite important and is going to show some progress and therefore provide some balancing to this hot CPI number we got today.
Look, the UK government, in the meantime, is trying to pump prime the economy with Keynesian economics. It's had a deal with India, it's had a deal with the EU, it's had a deal with the United States, it's had a deal with Asia and the acronym that no one can remember, so that's why I've got it in front of me, the CPTPP. So there seems to be a lot behind the scenes that over the medium to longer term should be boosting the UK economy. Are you modelling any of that at the moment?
We are including some of that in our projections, yes. So, for example, the US-UK trade deal, we lifted our numbers a little bit, but we think that was sort of worth 1/10 of a percentage point. We think the agreement with the EU is somewhat helpful, but probably not more than 1/10 or 2. So I would say these are relatively small effects compared to the overarching negative effects that we've seen from Brexit over the last few years. But of course, there's steps in the right direction, and more trade and freer trade is good for the UK. But I would say these are incremental steps in the right direction.
We're watching a lot of policy on the hoof at the moment, fast-moving policy that keeps on changing, at a point where central banks have to also determine what type of monetary policy they will set. We saw the dissenters crop up at the latest Bank of England meeting. What does that mean in terms of the data we're getting today, a hotter piece of data? Does that bring some of the members closer together and thinking about going more cautiously on rate cuts from here?
I think it probably makes the June decision easier to pause in June. So that does feel quite likely after the more hawkish commentary and then the data today. But I'm not sure that it does an awful lot beyond that in kind of bringing everyone together, because you do have very different views, I think, of how to read this data. So you have, on the one hand, you have members, including the chief economist, who worry very much about the persistence of inflation at these levels, and said, of course, earlier this week that he wants to be.
Sorry, let's go on that, Hugh Peel. I know we wanted to come back on this one. I absolutely admire, and he was obviously, the fly in the ointment, so to speak, the fact that he and Catherine Mann were going for Unch as well. But the fact of the matter is, we're in restrictive. We've got 4.25% raise. Even with this slightly hotter print, we are still way above, in terms of the base rate, what the actual inflation is. Where's the problem? I mean, there's wiggle room. It doesn't have to be 4%, 4.25, 4.5. I mean, it's not actually as exact a science as people make out. We're still restrictive, aren't we?
Yeah, we're still restrictive, and I think Hugh Peel would agree with that. He did say that in his comments, but his argument essentially is that inflation has repeatedly turned out to be more persistent than expected, particularly on wages, and that therefore rates need to stay restrictive to make sure we kind of push inflation out of the system. I would say the counter argument, which is being pushed by the members that dissented for faster cuts, is basically that these inflation pressures we're looking at today are quite backward looking, because a lot of these price resets we just talked about, they're really a function of last year's inflation, whereas the more forward-looking things, like a loosening labor market, the surveys, the weakening growth picture, are all things that would suggest that inflation over time should come down. And when you look at the MPC's latest projections, they actually have inflation at 2, a little bit below 2 in the forecast. And so I would say it's a question of how much weight you want to put on current inflation versus forward-looking inflation. And I think that's the big debate on the MPC.
There's no doubt the wage story has been still very supportive for consumption. We're seeing that through a bunch of numbers in recent weeks. I mean, Greg's yesterday, we've got Curry's and electricals out today. The consumption is still holding up, even if it's at a slower pace than we might have seen in previous quarters. At what point does some of the international macro position catch up with the UK consumer as well? When do you see that hitting?
Yeah, we see that really coming through already in the second quarter and then in the third quarter. So the first quarter was very strong. Partly because of the consumer, but partly also we've seen that across countries, that many countries in Europe saw very strong first quarter numbers because of trade and a front loading of trade that had kind of boosted industrial activity in the first quarter. And when we look at the surveys, they are weakening in the UK, across Europe. Of course, we'll get the flash PMIs tomorrow. That will be helpful. But we do think there's going to be some loss of momentum basically as we go into the summer. And we do have forecasts that are a bit weaker than what the Bank of England has for growth in the rest of the year.
Yari, let me pick you up on something you just said, that we need to pay more attention to the forward-looking parts of the inflation picture, and what you said about services inflation being where you were focused in today's report. Because when I think back to our conversation with Catherine Mann last week, she sort of suggested that we're all looking over here at services inflation, but we should be looking a little bit more over here on goods inflation, because there's a prevailing view that diversion of trade from China is going to lead to disinflation in the UK. But actually, she thinks that UK businesses are going to use lower prices at the dock as an opportunity to rebuild margins. So she's actually looking at the good side of the inflation picture, and she thinks we are seeing inflation there, not inflation coming down. What's your take?
Yeah, I will take a more benign view of what's happening on the goods inflation side. Our analysis would suggest that the rerouting of goods is net disinflationary as you kind of have more excess supply of goods globally. Now, with the US-China deal, that argument I think is weakened somewhat, so we would only look for a small negative effect from that. But on top of it, you also have other things that I think are affecting the outlook for goods inflation, which is lower energy prices, a stronger exchange rate. So I would generally say that on the goods side, I think things look relatively benign. And to me, it's more the nexus around wage growth and services inflation that we talked about.
The Trump tariff trade war, the NPR, as I'm sure we all read, had 0.3 of 1% effect on the British economy, but only 0.1 of that was direct. The 0.2 of that 0.3, the 0.2 was actually second round effects from trade wars elsewhere. So if China and the US have a positive outcome to their talks during the pause, does that mean another boost because that 0.2 will be taken off the table and actually UK GDP will be slightly better?
So that is a function of what happens elsewhere in the world, yes. Yeah. So, and it is true.
We focus very much on Britain and Britain's deals and Britain's inflations, but I'm thinking about we are no island. No man is an island.
Yes, and I would agree. I mean, our numbers are a little bit higher than the 0.3. We have about 0.5, but the sort of proportion is similar, that the direct effects are smaller than the indirect effects via what else happens in the world. So we've made progress on US-China talks, so that's been helpful. But now the big question is on US-EU talks and where we land there. Our baseline is fairly benign, that we will get the 10% essentially continued without a step up to 20% reciprocal tariff on the EU. But I think there's a risk still in those negotiations, and I think the EU will be sensitive to that, because the more of a hit we have to the trading partners, the more it will also spill back into the UK. So I think that's the right place to focus.
Yari noted around that 10% that we could still be left with in Europe. Thank you very much for joining us to help us with the UK data as well. Yari Sten with us, Chief European Economist at Goldman Sachs. UK Deputy Prime Minister Angela Rayner reportedly proposed Chancellor Rachel Reeves increase taxes in a bid to raise up to £4 billion a year ahead of the spring statement in March. That's according to a memo seen by the Daily Telegraph, which suggested raising corporation tax on banks and reinstating the pensions lifetime allowance. Reeves appears to have ignored those proposals, though, choosing to cut public spending instead to meet her fiscal rules. Now, the report suggests a deepening split within the Labour Party on economic policy. Bank of England chief economist Hugh Pill says the bank has been cutting rates too quickly. He was one of two policymakers to vote for a hold this month. Pill characterised his vote as a skip rather than a hold, citing concern that the pace of easing has been too rapid in the face of risk to price stability. He says the key rate plateaued at slightly too low a level in 2023 when the bank was battling high inflation.
Let's get a check on U.S. markets and how Wall Street fared yesterday. We did see a bit of a retreat from equities yesterday. All three of the majors ending modestly lower, fairly contained in terms of the magnitude, but the direction of travel south. The Nasdaq closing about 0.4% lower. The S&P 500 breaking a 6-day win streak to close 0.4% lower, and the Dow Jones slipping about 115 points. Asian markets, the overnight trade. Here's where things stand at the moment. You got a bit of a pullback on the Nikkei 225 over in Japan, about 0.5%. We are looking at modest gains, though, elsewhere in the region. As for European trade, here's what the early indication is. We're about 45 minutes away from the European market open, and we're looking at a marginal pullback here as well, so similar to what we saw on Wall Street yesterday. Finally, U.S. futures, what's in store for today's start to trade stateside? Well, we're looking at a pullback, so further losses in the U.S. market. The Dow Jones looking to drop about 180 points, so adding to yesterday's more than a 100-point pullback, and the Nasdaq looking to drop about 132 points as well.
Is it just me out there, or does everyone in TV news struggle to say the name of the next story without putting on a Donald Trump voice?
Just Britishified. Big beautiful bill.
Big beautiful bill.
I don't know what I was going for yesterday.
I can't. You went quite deep, didn't you?
I don't know what I was channeling, but it does sort of bring something out of you.
It has a resonance to it. It has an alliteration. You kind of want to do it in a Trump-esque way, and that's a compliment to Mr. Trump.
It's headline news, so no doubt every anchor in every country is having to do it anyway. So you've seen lots of interpretations.
President Trump met with Republican House members on Capitol Hill, urging lawmakers to pass his big, beautiful bill, budget plan. The legislation narrowly cleared a procedural hurdle before the House's Budget Committee late on Sunday night, but some hardline Conservative and more moderate GOP members as well have expressed their reservations. Now, 3 lawmakers inside the meeting told NBC that Mr. Trump told members holding out for a larger state and local tax credit to let it go, whilst 2 lawmakers said he used an expletive to warn against further Medicaid cuts. Mr. Trump also said he can afford to lose only 3 Republican votes when it goes to the House floor due to the very tight numbers in the House. Speaking to reporters after the meeting, the president expressed confidence the bill would pass.
It's not a question of holdouts. We have a tremendously unified party. I don't think we've ever had a party like this. There are some people that want a couple of things that maybe I don't like or that they're not going to get. We're going to have a bill, the one big beautiful bill. I think it's the biggest bill ever passed, and we got to get it done. Tremendous tax cuts for people, tremendous incentives, tremendous regulation cuts, all these regulations that are so horrible.
Something else. The House Rules Committee is currently meeting to vote on the budget legislation in the final procedural step before it moves to a vote before the full House, which Speaker Johnson says could happen as soon as today. It's fascinating. Ralph Norman, one of the Conservative holdouts on the bill, who is also a Rules Committee member, has said he will vote to allow the bill to move forward in a boost for the Republican leadership, even as he declined to say whether he would support it on the House floor.
Plenty coming up on the show. The UK and European Union unveil fresh sanctions on Russia without waiting for the US. We'll have more after the break. Plus, Elon Musk sets a timeline for the rollout of robo-taxis in the States. We'll bring you more from our US colleagues' interview with the Tesla CEO. And shortly we'll be joined by the CEO of Cisco. Later this hour, that's Chuck Robbins. Don't miss that exclusive conversation in about 15 minutes' time.
The United Kingdom has suspended free trade negotiations with Israel and summoned the country's ambassador to the Foreign Office, as well as imposing fresh sanctions on settlers in the occupied West Bank. International pressure on Israel over Gaza has increased in recent days as it steps up its military operation in the enclave and restricts aid. Back to one of the other top stories this hour. The UK and the European Union have unveiled fresh sanctions against Russia, targeting Moscow's shadow fleet of oil tankers, along with the supply chains of weapons systems and financial firms. European defence makers are seeking more capacity as Europe raises military spending, and they're capitalising on slowing demand for autos. Well, let's get to Annetta, who has without doubt been our point person, because there's so many interesting companies, Annetta, and you've spoken to many of the top brass at places like Renk and the other key manufacturers, Leopard tanks, gearboxes, you name it as well. Tell us more.
Yes, indeed. It's a very interesting time if you look at the German industry, because at one point we look at the car industry, and that's obviously shrinking given lower demand for cars, but also higher competition from the likes of China. And we were very concerned about the massive layoffs happening in that part of the industry, but it seems that it's actually getting digested by the defense industry. And that's the interesting story here, because even some car makers or car parts suppliers as Schaeffler are moving into the defense space. Stihl, for example, another mid-cap company, is also moving into the defense space. They're producing also gearboxes. But I've been to Renk, and Renk is unique because it actually has 75% of the market share of the world when it comes to gearboxes for tanks, and they are actually producing them also for US tanks, they're producing them for Korean tanks, for Japanese tanks, so they're all over the world. And the only thing they need is higher production capacities. The new CEO I've been speaking to was actually quite confident that they can attract people from the car industry, and by that as also be able to enlarge their production capacities and also meet demand. He's saying that it takes roughly a year now to produce a gearbox, which is a complex system, but those gearboxes actually last not forever, but for many decades. They are also getting refurbished at Renk. So it's a massive business sitting in Augsburg, just an hour outside Munich. But perhaps we listen in of what I've collected on the ground down in Augsburg.
Amid the war in the Ukraine and a strained US security partnership, Europe's largest economy is stepping up its defense efforts. I'm here at Renk, one of the world's largest gearbox maker for tanks that is playing an important role in Germany's and Europe's defense buildup.
Earlier this year, Germany passed a historic fiscal package which will allow for a major increase in defense spending. This has led to a surge in share prices of defense companies, with Renk's share price having climbed around 40% since March, when the Bundesrat passed the reform package. To find enough employees in production facilities, defense companies are collaborating with car manufacturers around Germany. Alexander Sagel, the CEO of Renk, is explaining why and how the skill set of car workers is also fitting into the requirements of a defense company like Renk.
Absolutely, and as you might know from my CV, I'm coming many years ago from the automotive industry. We have many applicants coming through all kind of education and qualification levels coming from the automotive industry. So we are benefiting, especially when you talk about technologies like electrification and digitalization. There is, of course, a gain and a benefit for Renk to incorporate these experts. But it's not that we will take over automotive plants and convert them into new Renk military plants.
Given the German auto industry's recent struggles, Deutsche Bank analysts believe moving capacities to defense could materially cut the price tag for restructuring the car industry.
We are currently really hiring a lot of people, and therefore we're also looking in the automotive industry. Automotive is by far the biggest, challenging industry. So it's hard competition, and therefore it's a very mature industry in the manner of planning, in the manner of continuous improvement and things like that. And before that background, as I said before, We are looking really for engineers who have that education, who can adapt to our industry and bring in the methods which we have in automotive, like continuous improvement, like line-back principles to increase efficiency, to increase quality. This is what we are really looking for.
Despite the opportunities, analysts warn that there are also challenges. It could take years to repurpose car factories and complete hiring processes. Trade tensions are also likely to weigh on Germany's economic recovery. Nonetheless, as Germany's iconic auto assets are tapped for defense, shifting priorities could help to lift Germany's sluggish economy.
But there also are examples that, for example, KNDS, the private-held Leopard or Leopard 2 producer, is actually taking over a train factory in east of Germany. So there are examples that this is happening. With Renk, they're saying they're not planning on doing so. They are planning on expanding their existing production capacities. And they're also in the key position or pole position to actually also deploy their gearboxes to the new European tank, which is in the making, because they are the only gearbox maker in Europe which actually can handle those massive tanks and the heavy weight of 40 to 70 tons, which is, of course, a lot. And they are also as I said before, in a very prominent position in the world market, also in the United States, but also in Asia. So I think we're going to talk a lot about them in the future.